Imagine a company right in the middle of, this booming green energy transition.
Right, the place everyone wants to be right now.
Exactly. And they're manufacturing an absolutely critical component for modern infrastructure. Like, year over year, they are physically pushing out 14% more of their flagship product.
So the demand is visibly there.
It is. Demand is up, revenue is up, and yet somehow they're bleeding $43 million in a single quarter.
Yeah, it's a brutal reality check, really. It shows how industrial commodity cycles actually operate.
Because, growth in a green technology sector, it doesn't just automatically guarantee wealth for the suppliers, right?
Exactly, especially not if the entire global supply chain, over-anticipates that revolution and floods the market.
And that is the core paradox we're looking at today. We're pulling directly from GrafTech International's Q1 2026 earnings release and their strategic presentation deck from May 1st, 2026.
Lots of fascinating data in there.
Yeah, totally. So our mission for this deep dive is to decode the financial reality of this company. They make a highly specific, practically invisible component that the global steel industry completely relies on.
And they are trying to survive a really, really hostile market right now.
Right. We want to figure out what their survival playbook looks like.
Okay.
Okay, let's unpack this core tension between high demand and low profitability. Because to understand the financial bleed, we first have to really understand the manufacturing floor.
We do. And, the global steel industry is in the middle of this massive structural shift right now.
Moving away from the old way of doing things.
Right. Historically, steel was made in these integrated blast furnaces, facilities that just burn raw coal and iron ore.
Which is incredibly carbon intensive.
Hugely. So the industry is rapidly pivoting toward electric arc furnaces, or EAFs.
So the way I like to think about an electric arc furnace, it's like an analogy. Imagine you're trying to bake a cake, right?
Okay, I'm with you.
But instead of using an oven, you use a massive, high-tech lightning bolt to just instantly melt scrap metal.
That's actually a pretty good way to visualize it.
You're creating this contained electrical storm. It liquefies recycled scrap metal at like 3,000 degrees Fahrenheit, which is just vastly more energy efficient.
It is. But to channel that kind of raw, destructive electrical power without, melting the delivery mechanism itself, you need a highly specialized wand, essentially.
Like the lightning rod.
Exactly. You need these large columns made of synthetic graphite. They're called graphite electrodes.
And graphite is unique here, right, because of the extreme heat.
Yeah, graphite doesn't melt. At extreme temperatures, it sublimates.
Meaning it goes straight from a solid to a gas.
Right, but only at incredibly high thermal thresholds. And it also conducts electricity exceptionally well. So without these graphite columns, the entire electric arc furnace process just stops.
Wow.
You literally cannot manufacture this greener steel without them.
So they're manufacturing the literal spark plugs for the global green steel engine.
That's a great way to put it, yeah.
Knowing that, set up the Q1 2026 numbers for us.
Yeah.
Because on the surface, the top-line metrics suggest a company that should be doing great.
Well, the physical production and sales metrics do look robust. In the first quarter of 2026, GrafTech's sales volume hit 28.1 thousand metric tons.
Which is up, right?
Yeah, that's a 14% increase compared to the same period the previous year. And their net sales reached $125 million, which is up 12%.
Okay, so they're selling more, making more top-line revenue.
Right. They were running their global facilities at a 65% capacity utilization rate. They produced 29.4 thousand metric tons of product.
They are moving massive tonnage. That is a lot of physical product.
They are. And here's the catch. Despite that 14% surge in physical volume, they reported a net loss of $43 million for the quarter. Yeah, or $1.66 per share. And if you look at their adjusted EBITDA, which, strips out certain accounting anomalies just to show core operational profitability, they were in the red by $14 million.
So still losing money on operations.
What's fascinating here is the absolute decoupling of volume and value.
Right, because usually more volume means more profit.
Normally, yes. But operating a heavy industrial plant at 65% capacity and increasing your sales volume, it means absolutely nothing to the bottom line if your unit economics are structurally broken.
That is the part that just defies basic logic to me. Like, if you are listening to this and you know anything about basic supply and demand, you have to be wondering how a vital component in a growing industry becomes a money loser.
It seems counterintuitive.
It totally does.
Hmm.
If graphite electrodes are the bottleneck for this new green steel, why aren't the unit economics holding up?
Well, it's because the market has fallen into a classic commodity cycle trap.
Which means what exactly?
Extreme, uncoordinated overcapacity. Over the last few years, international competitors, primarily located in China and India, they looked at the long-term forecasts for electric arc furnace growth.
Oh, I see where this is going.
Yeah, they assumed demand would just scale up in an endless vertical line.
So they anticipated a gold rush and basically built way too many pickaxe factories.
Exactly. And when all those new international facilities finally came online, they flooded the global market with excess graphite electrodes.
And I'm guessing the demand didn't skyrocket the way they thought it would?
Not even close. In Q1 2026, global steel production, if you exclude China, it only grew by about 1%.
1%. That's nothing.
Right. So you have this massive tidal wave of new supply hitting a market where demand is barely inching forward.
Which instantly destroys pricing power. I mean, it has to.
The collapse is severe. GrafTech's weighted average realized price dropped to roughly $3,900 per metric ton in Q1.
Oh, wow.
Yeah, that's a 5% decrease year over year. Management was very direct in the earnings release. They described the current pricing environment as unsustainably weak.
Because everyone is just undercutting each other.
Every manufacturer is fighting for market share in a stagnant pool. And they're doing it by slashing prices to the absolute bone.
It seems like that global average price is just dragging down their overall financial health.
Yeah.
But looking at the regional breakdowns in the presentation, it isn't a completely uniform disaster everywhere, right?
No, there are isolated pockets of strength. Like GrafTech saw a 37% volume growth in the United States.
That's huge.
It is, and the U.S. continues to be their strongest pricing region. But the problem is, when you blend those domestic numbers with their global sales, the sheer weight of all that overseas overcapacity is just anchoring their overall realized price to that $3,900 mark.
Which we're going to see in a minute is perilously close to what it actually cost them to make the stuff.
Dangerously close.
Right. And a company can't just absorb a $33 million loss every 90 days and just, hope the macro environment magically fixes itself.
What if they go bankrupt?
Here's where it gets really interesting. Because GrafTech is taking an aggressively counterintuitive approach to this flooded market.
They're deliberately changing the terms of engagement, which is bold.
Because usually, what's the standard instinct in heavy manufacturing during a downturn? You chase volume.
Exactly. You slash your prices to match the lowest bidder just to keep your factory running and try to cover your fixed costs. But GrafTech is doing the exact opposite.
Wait, how is that mathematically possible? If the market is drowning in cheap electrodes from overseas, how can GrafTech realistically walk into a negotiation and demand a price increase?
It sounds crazy, right?
Yeah. Wouldn't their customers just walk across the street and buy from an international supplier?
Well, they are isolating a very specific segment of their business. GrafTech is enforcing price increases of $600 to $1,200 per metric ton, but strictly on their uncommitted volume.
Okay, so on a product that averages $3,900, they're demanding a 15 to 30% premium overnight.
Yes, and they are fully prepared to lose the sale.
Really? They'll just walk away.
The sources detail how they are explicitly walking away from business foregoing volume opportunities if the margins are just unacceptably low. They are simply refusing to participate in this race to the bottom on the spot market.
Man, they have to have some kind of structural safety net to play that aggressive of a hand. I mean, if they lose those spot sales, they still have to keep the lights on at the factory.
Their safety net is their existing order book.
Okay, so pre-sold stuff.
Exactly. Over 85% of their anticipated 2026 volume was already committed before they started playing this hardball strategy.
Oh, wow. 85%.
Right. So they aren't trying to sell their entire factory output at these elevated prices today. They have a solid baseline of committed revenue.
Which gives them the breathing room to be highly selective with that remaining 15% of uncommitted inventory.
Precisely. It is a calculated gamble on value over volume.
And they are backing up that sales strategy with, legal and geopolitical maneuvering, too. The presentation explicitly outlines their active support for trade cases in key jurisdictions, like the United States and Brazil.
Because those trade cases are a mechanism to structurally alter the market dynamics.
How so?
By advocating for anti-dumping tariffs or import duties, GrafTech is essentially attempting to legally quarantine all that cheap, oversupplied overseas product.
Oh, I see. They're trying to build regulatory walls around their most profitable regions.
Right. If a tariff is applied to imported electrodes, the foreign competitor loses that artificial price advantage, and that effectively resets the baseline price in that region closer to GrafTech's target margins.
But trade investigations and tariff implementations, those take months, sometimes years, to resolve.
They are very slow.
So implementing price hikes on spot volume might help a little at the margins, but it doesn't instantly erase a $43 million quarterly loss.
No, it definitely doesn't.
How does a heavy industrial manufacturer survive the immediate cash burn while waiting for these macroeconomic chess moves to play out?
Well, survival in a commodity trough comes down entirely to liquidity and debt structure.
Okay, so looking at their balance sheet, GrafTech is sitting on $329 million in total liquidity.
Which is pretty healthy.
Yeah, that's a combination of cash on hand and available funds under their revolving credit facilities.
Yeah.
But their gross debt is massive. It's sitting at $1.125 billion.
Right. A debt load of over $1 billion sounds terrifying, especially for a company that's currently posting negative EBITDA.
Definitely.
But if we connect this to the bigger picture, the absolute size of the debt is actually secondary to the maturity schedule.
Okay. When the bill comes due.
Exactly. GrafTech has essentially no debt maturities until December 2029.
Okay, that changes things. So they don't have a massive balloon payment due next quarter that could trigger a default.
No, they have a 3.5-year financial runway.
They just need that $329 million in liquidity to cover the operational burn rate until the cycle finally turns.
And they are actively shrinking that operational burn rate, too. In Q1 2026, their cash cost of goods sold per metric ton declined 4% sequentially, bringing it down to $3,848.
Oh, wow. Which puts their situation into stark perspective, right?
It really does.
If the weighted average selling price is around $3,900 and the cash cost just to manufacture a ton is $3,848, the gross margin is functionally non-existent.
It's basically zero.
Yeah. Once you add in corporate overhead, legal fees for those trade cases we talked about, interest payments on the billion-dollar debt, you immediately see why the net income is deeply negative.
Absolutely. And driving that unit cost down even 4% requires extreme operational discipline. They are optimizing their raw material consumption, aggressively managing power costs.
Which has to be highly complex for their European facilities, given the ongoing energy volatility over there.
Extremely complex. But their biggest lever for cost control is actually a unique structural advantage they have: vertical integration.
The earnings deck heavily emphasizes this. GrafTech is the only large-scale graphite electrode producer that is substantially vertically integrated into a material called petroleum needle coke.
And to understand why this is such a massive differentiator, we need to look at the chemistry of the manufacturing process for a second.
Okay, break it down for us.
You don't just make a premium graphite electrode out of standard coal. You need petroleum needle coke, which is this highly crystalline form of carbon. It's derived from decant oil or coal tar pitch.
Sounds intense.
It is incredibly difficult to manufacture. It requires weeks of high-temperature baking.
But why does it have to be this specific needle structure? Like, why not regular carbon?
Because of thermal expansion. Remember the lightning bolt analogy? When an electric arc furnace hits 3,000 degrees, the electrode heats up very, very rapidly.
Yeah.
Well, most materials expand when they're heated. If the carbon structure isn't perfectly aligned, like tightly packed needles, the electrode will expand too fast, it'll crack, and it'll catastrophically fail right inside the furnace.
Oh, wow. That sounds dangerous.
Very. But petroleum needle coke has a very low coefficient of thermal expansion.
So it is the absolute critical precursor material. And while their competitors have to just go out and buy this needle coke on the volatile open commodities market, GrafTech makes a substantial amount of their own.
Right. It acts as an internal hedge. It insulates their cost of goods sold from sudden supply chain shocks or raw material price spikes.
Which probably routinely devastate their non-integrated competitors.
Oh, constantly.
But even with that hedge, the pressure on the operations team to cut costs must be immense. And usually when industrial companies are bleeding cash and just desperately trying to shave dollars off the cost of goods sold, things like facility maintenance and worker safety are like the first corners to get cut.
Sadly, yeah, that happens a lot.
The GrafTech safety metric, their total recordable incident rate, or TRIR, it's sitting at 0.35.
Which is incredible. In heavy industrial manufacturing, a TRIR of 0.35 is exceptional.
Really?
Yeah, it indicates that the severe financial stress at the corporate level hasn't translated into compromised physical safety on the factory floor. They are grinding down costs through actual process optimization, not by putting their workers at risk.
Okay, so let's summarize their position. They have the liquidity to survive until 2029.
Yep.
They are defending their core markets with aggressive trade cases. They're leveraging their needle coke integration to grind down unit costs. The strategic holding pattern is clear. But what is the actual catalyst they're waiting for? Like, what's the light at the end of the tunnel?
They are looking past the stagnation of 2026 and focusing heavily on the projections for 2027.
Okay, missed you.
Right. They cite the World Steel Association forecast, which models a pronounced acceleration in global steel demand. By 2027, demand outside of China is expected to accelerate to a 4.0% growth rate.
4%. I mean, in a global commodity market as massive as steel, a 4% growth rate is an astronomical amount of physical volume.
It translates to millions of tons of new capacity required. And the macroeconomic drivers behind that 4% are really solidifying now.
Like what?
We are seeing sustained infrastructure investments across major economies. There's a global increase in defense spending, which is highly steel intensive.
That makes sense.
And we're looking at the anticipated easing of monetary policy, which lowers borrowing costs and naturally stimulates large-scale construction projects.
And because of tightening environmental regulations, a disproportionate amount of that new steel demand has to be met by electric arc furnaces.
Exactly, which drives up the baseline demand for graphite electrodes.
And here's a twist, that steel industry isn't the only sector fighting for these raw materials, is it?
No, it's not. The broader energy transition is creating a massive secondary market for petroleum needle coke.
Wait, really? What else is it used for?
It isn't just used to make electrodes for melting steel. That exact same highly crystalline carbon structure is a critical precursor material for manufacturing synthetic graphite used in the anodes of lithium-ion batteries.
Oh, wow. So for electric vehicles.
Exactly.
Meaning the supply chain for electric vehicles and energy storage is on a direct collision course with the supply chain for green steel.
You nailed it. Demand from the EV battery sector is projected to accelerate significantly in the coming years.
And as battery manufacturers lock up secure supplies of needle coke.
It tightens the availability for the electrode manufacturers, which intrinsically drives up the value of GrafTech's vertically integrated production capacity.
So what does this all mean? GrafTech is enduring a brutal loss-making quarter today because they are sitting right at the convergence of two global megatrends.
Two massive shifts.
They have the electrodes required for the greening of the steel industry, and they hold the raw material required for the electrification of transport.
Right. If their management team can successfully walk this tightrope, servicing the debt, maintaining strict discipline on their uncommitted volume pricing, and seeing those trade cases through to fruition, then the structural dynamics of the 2027 economy are perfectly positioned to turn their current overcapacity crisis into a profound supply advantage.
Which brings this entirely back to you, the listener.
Yeah.
We hear constant political discourse about the green transition.
Yeah.
Multi-billion-dollar infrastructure bills, mandates for electric vehicle adoption, the push for sustainable cities.
It's in the news every day.
Exactly. And we are conditioned to picture the sleek, finished results of those policies.
Right.
But this deep dive illustrates that these massive societal shifts, they do not happen by decree.
No, they take physical materials.
Right. They are constrained by the gritty, high-stakes reality of industrial manufacturing. The timeline of the electric vehicle revolution is fundamentally tethered to the profit margins of companies making unglamorous components like graphite electrodes.
The transition away from carbon-intensive infrastructure requires an entirely new, highly specialized supply chain. And as we've seen in GrafTech's Q1 results, that new supply chain is currently dealing with extreme volatility, overcapacity, and totally fractured pricing power.
Which leaves us with a provocative question to consider long after this deep dive ends. If the entire global push for green technology relies so heavily on specialized, geographically concentrated materials like petroleum needle coke, how resilient is our path to a sustainable economy, really?
It's a great question.
We just explored how a flooded market in international trade disputes can push a vital supplier to the brink of unprofitability. Are we attempting to build a clean, electrified future on top of a supply chain that is remarkably fragile? one that could be derailed not by a lack of technological innovation, but just by the raw, brutal economics of the commodity cycle.
It really forces us to realize that the green revolution is only as viable as the unit economics of its most obscure industrial links.
Something to think about the next time you see a new electric vehicle on the road or, a steel high-rise going up in your city. Thank you for taking the time to explore this complex industrial landscape with us.